we had quite a good first the quarter, and the results were released to CST yesterday evening. So this is basically the discussions that we are going to have with the investors to share some more insights about our numbers and clarify whatever the questions you may have as we move along. With me, I have the part of my leadership team, Bonika, who's heading the corporate banking function, the Sanjay Pereira, who's heading the retail and the branch banking function, then Indika Ranavira, who's heading the SME and middle market, and Iran, who's heading the treasury, and of course from the finance, we are Suendri Chandana and the finance team. Moving on to the business overview. Bank, of course, this is about the corporate profile. I think those who are quite familiar, I don't want to repeat, but I think we were established as a development finance corporation and then moved on to the commercial banking side. We have expanded rapidly in the commercial banking area since 2005. Staff strength is more than 2,100 now. And our vision is to be one of the driving force for financial empowerment Sri Lanka. And that's where we continue to develop the lives of people who are working with us, dealing with us, and enriching the economy of the country. So in terms of the reach, we have now 107 branches and 118. And during the quarter, we opened our latest branch, NDB Private Wealth Center, at the in Tambalapitiya. That was opened actually 2 months back. This is again with our strategy in ensuring that the group companies, now we have investment banking, the wealth management, and stockbroking, various investment banking activities being carried out. So we got it under one roof, and then we moved our NDB Bank branch also to cater to these clients and offer wealth management solutions one stop. So that was part of our vision, and that's the first branch that we opened this year in Bangladesh. To the clients, of course, mobile banking is one of the major platforms that we have been using, and which is and recognized mobile app in the market, and also it's quite shown in terms of the number of transactions that are to the mobile app. We have about 3 billion worth of transactions, rupee 3 billion worth of transactions during the first 9 months of the year. This is again getting back to the bank's structure, the group structure. NDB Bank, under that we have 99% holding on NDB Capital Holding, which is the full service investment banking arm. And under that we have NDB Investment Banking, NDB Wealth Management, which is involved in wealth management activities, NDB Securities, who is doing investment advisory and securities trading, and NDB Zephyr, which is the investment fund, equity fund, private equity fund, which is involved in supporting the up and coming businesses. Apart from that, we have 58% investment in DHPL, which is the property owning arm, with a joint venture arrangement with Export Development Board. The balance ownership is with EDB. And then we have 77% exposure, ownership of NDB Capital, Bangladesh, which is conducting investment banking activities in Bangladesh. During the quarter, actually, we were recognized by receiving various awards. These are some of them. Of course, the Global Banking and Finance Review, we recognize our mobile banking app, and also as the best SME bank in Sri Lanka for 2017, and also for the best investor relations. Similarly, the CFA Institute also, during their annual award ceremony during this quarter, recognized NDB as the best investor relations corporate entity, and we really value that. And these kind of investor webinars and clarifications seminars actually helps us to keep that edge as one of the investor-friendly institute who is willing to share information that is needed for the investors. In the Asian Bank and Finance Magazine of Singapore, again, they recognize us as the best domestic retail bank and also SME Bank of the Year, and also for our mobile banking app. And Asian Bank and Finance Magazine, they recognize us for best domestic project finance bank of the year. This is for the third consecutive year. In fact, our project financing business is quite active. They are quite well involved in a lot of project development, developing projects that are happening in the country, and that has been recognized through this award. And also for our domestic cash management side, that is again for the second consecutive year. In terms of local awards, as I mentioned, the CFA Sri Lanka Capital Markets Award, we were the Gold Award winner for the second consecutive year for the best investor relations among the listed entities in Sri Lanka. Then the SLT 01 Award, best use of mobile under the financial sector category. And the Lanka Pay Technovision Award, we were the runners-up, the best mobile payment application of the year. And our investment banking arm, they won several awards, Euromoney Awards for 2017, Best Investment Bank in Sri Lanka. This is actually the sixth consecutive year that we won this. And then the Global Brands Magazine for the most trusted investment banking brand, and Asian Money Banking Awards, Best Corporate and Investment Bank in Sri Lanka. Apart from that, our Bangladeshi subsidiary also won the Euromoney Award for Bangladesh for 2017. Moving on to the macroeconomic analysis, of course, the country's growth rate grew by about 3.9%, and the expectations are to be somewhere between 4 to 4.5% by the end of the year. The rupee depreciated by about 2.6% against the US dollar up to 25th October. And the credit to private sector, as per the central bank latest reports up to September, the credit growth has decelerated, but there's still 17% growth. This is actually a low growth compared to what it was last year. And the expectations from the central bank is, with the monetary controls in place, the credit growth to come down to around 15-16% by the end of the year. Market rates adjusted upwards and appear to have been stabilized. Short-term rates have also, we have seen a little reduction in the short-term rates due to availability of the liquidity in the market. Inflation is expected to decline. Of course, the October-November there was a spike, one of the drought effect, and also there's a year-on-year. Last year, same time, there was a VAT impact that basically had an impact in having a lower inflation because the VAT was removed for some time, but then again VAT was reintroduced towards the latter part of last year. So this year-on-year change is expected to narrow down by the end of the year. And of course, the country is now progressing based on the economic policy framework that the government introduced, spanning up to 2025, titled Vision 2025, a country in reach. In terms of banking sector developments, at the entire banking sector, the total assets is now 10 trillion rupees. And of that, loan book is about 6.2 trillion rupees. We roughly have NDB roughly about 4.3% of the lending book market share. Industry NPL rate is now around 2.7%, banking industry NPL rate, whereas NDB has come down below 2% and we are at 1.96 as at September 2017. Monetary policy rates remain unchanged during last few months. SDFR at 7.25 and LFR at 8.75. This is actually since March 2017. The monetary policy had been it's retained at the same rate. Moving on to the bank's third quarter financial performance. This is a comparison between last year third quarter versus this year third quarter. The net operating income, that's where we saw quite a good growth. We ended up with 11.1 billion rupees. This is 33% growth from 8.3 billion last year. The operating expenses, the growth was 13% from 4.8 billion to 5.4. This includes some one-off expenditure that we incurred during the last quarter, which we'll explain later when we have more detailed discussion on the operating expenses side. And as a result, the profit after tax, we had 64% year-on-year growth from 2 billion last year to 3.3 billion in the first 9 months this year. In terms of the balance sheet, the total assets, we had 11% growth. This is actually from December last year to September, so 9 months, 11% growth in the total assets, up to 371 billion. And the loan book grew by 14%, up to 259. We had 31 billion growth in the loan book. And also deposits, I think this would have been the highest, 51 billion growth in deposits. In terms of percentage, is 25% growth from 204 billion to 255 billion. And what is important is in that growth in the deposit, we had about 6 billion growth in low-cost CASA as well. There's a very focused approach in growing our deposits and ensuring our advance to deposit ratio is continue to be maintained and brought down to 100, because historically we were above 100, and then we are moving towards well within our targets of bringing it well below 100%. In terms of efficiency ratios, cost to income ratio has improved from 49% last year to 45.8%. Interest margins, again, we have seen sizable improvement from 2.6% to 2.9%. Of course, compared to the market, this is slightly below the market rate, but we have seen very good improvement. This is the entire total assets. When you compare the interest margin, it's the total assets which is used as the denominator. So with the asset growth, still improving on the NIM to 2.9 is quite a good progress that we have made. If you compare the month-on-month, the monthly NIM, I think we have topped about 3.3% for the month of September. So that improving the interest margin process is continuing, and we are expecting that to reach to some very good levels by the end of the year, crossing around 3%. Return on equity, again, quite a sizable improvement from 13.3% to an ROE of 15.66%. And we will continue to work on improving our ROE numbers. Then the NPL, again, a very good improvement from 2.63% in December it has come down to 1.96, first time below 2% after a long time. So that's again quite a good improvement in terms of the quality of the book. In terms of business capacity, the loan to deposit ratio, this is something that we keep on improving. So end of December last year, we were at 115%, which has now improved to 104. And then the capital adequacy, we are well within the capital adequacy requirements. Now it is 12.5%. And in terms of liquidity, again, well above the minimum liquidity level of 20%, we are at 24%. This is an income statement. Again, quarter-to-quarter comparison, bank level and also at group level. So bank level, net interest income, 23% growth from 6.2 billion to 6 billion. And in addition to that, what is more significant by 29%. From 9.3 to 8 billion. Impairments slightly reduced, about 100 million reduction compared to last year Q3. So total impairment charge was 872, the cumulative impairment charge for the year up to 9 months. Operating expenses, again 4.8 billion to 5.4, 13% increase. There is a one-off expenditure as well, which I'll explain later on. So overall, as a result, the tax figure has also gone up by 56%, from 1.5 billion to 2.3 billion. Overall, after tax profit, we had 64% growth, from 2 billion to 3.3 billion rupees. That's about 1.3 billion rupee increase from last year 9 months to this year's 9 months. So actually, apart from the growth in the balance sheet in terms of the financial performance, we had very impressive growth in both financial profitability as well as, and this is coming from the core banking activities, coming from all the business sectors. It's not coming from one side, it's well diversified and coming from all business sectors. So that's the beauty of, I think, that we have been achieving that progressively in all 3 quarters, and all business lines are contributing to this growth. Of course, the expectations from the group companies has come down because of the subdued capital market activities. So as a result, compared to last year first 9 months, the contribution from the group companies was less, and I think we are reviewing that, and also we are looking at other opportunities that are coming. There are a lot of investment banking activities that are going to catch up in the market, and we are looking at those opportunities, and we are ready, we are comfortable that we can look at those when the opportunity comes. This is getting more details into the revenue analysis. The net interest income, we have 27 billion net interest income. There's 33% increase. These actually the 2 contributor factors are, of course, the steady growth in the loan and advances book. As I mentioned, about 31 billion growth in loans and advances. Other one is the improved margin. We consciously looked at margins and challenged wherever the margins are low. And also on the other side, we looked at bringing our cost of funds down. And as a result, from both sides, we have been improving on the NIM. So as I mentioned, the September month alone, the NIM is about 3.3, but cumulative over the 9 months, the NIM, net interest margin, has improved from 2.6 to 2.9%. So that is reflected in the growth in interest income, 33% growth in interest income. By 54 billion compared to the lending growth of 31. So deposits had substantial growth, so that basically was the main reason for the growth in interest expenses. But all in all, net interest income, that is where we really measure what exactly is the progress. It has gone up from 6.2 billion to 7.6 billion. So 23% growth in net interest income, and margin from 2.6 to 2.9. The non-interest income, again, it's a good story. The fee-based income, we had 10% growth from the trading income, trading gain from 693, and net gain from the financial investment, again, 199 million to 545. The other operating income, 113%. We have more than double the other operating income from 570 to 1.2, and this includes the dividend payments that we receive from the group subsidiaries. So total non-interest income has gone by 41%, from 3 billion to 4.3 billion. Of course, our plan, we devised our strategic plan in early this year, and one of that strategic imperative is to improve on the fee-based income and bring it up to a much more sizable, larger figure than what we have, from current 19% to 25% over the next 3 years. Getting back to the operating expenses, now there again it's broken into 3 parts. The personal expenses, we had only 1% growth in personal expenses from 2.6 billion to 2.645, and that's, I believe, is quite a sizable and good achievement, despite working on staff internal increments and improving on the staff costs, that we managed to bring down on other expenses, so that we managed to keep this personal expenses, the growth around 1%. Of course, the last quarter there were some salary adjustments done, so that is expected to slightly go up, but still very well contained within the budgeted numbers. And then the other expenses, now increase of 35% from 8 billion to 2.5. Now this is where there was one of August. This is actually prepayment charges of large borrowing, foreign currency borrowing, that was prepaid. This is actually a conscious strategic decision that we took, because these borrowings were at a higher cost, and when the ability to deploy them at a higher level was leaving a margin was quite restrictive. So we took a decision to prepay this foreign currency loan from a financial institution, which helped us to improve on the interest margin significantly. And the benefits are expected in the next 3 to 4 years. But of course, there's a one-time prepayment penalty that was charged the year. But we are comfortable that even within the year, we can basically cover that. And by end of the year, we should be able to. So it's expected to give further returns in the next 3 to 4 years. So if not for this prepayment charge of foreign currency loan, the increase in the operating expenses is only 8%. So this is compared to the country admin expenses and all, 8% increase is quite commendable. Last 9 months compared to the last year first quarter, first 9 months. So that itself also has increased the cost structure, but despite that, the overall increase is 8%. Moving on to the balance sheet, overall 11% growth in total assets from 334 billion balance sheet. Now we have moved on to 321 billion balance sheet. And the growth has come from mainly the loan book. Loans and advances. In terms of the liability side, mainly the growth is in the deposits. As I mentioned earlier, we had 3 billion growth in deposits from 203 billion to 255 billion. Group level, the total assets, we had a 10% growth from 340 billion to 376 billion. And in terms of equity, we have 29 billion last year, which has grown up to 31.9 billion, the group equity level. Further breakup of the loans and advances, the year-to-date growth is 14%. So we are now up 259 billion growth in the total loan book. Again, the growth has come, as you can see from the pie chart. It's quite a mixed pie chart. There are 35% of the assets on the corporate book, 22% for the finance, 20% on the market, and 3% the other assets. So it's actually the target is to grow the retail and SME side, and that's where we are working on. That is part of our strategic plan to grow more, because we have already invested in branch banking. Now about 50 branches are added into the system for investments, provide full support to the growth, and then that's why the strategy also is going to focus more on SME, the middle market side. Apart from that, the local currency to foreign currency mix of the balance sheet. Now, right now, it's roughly 25% in the rupees, which will be moving gradually and more towards more rupee-based balance sheet. So even the pre-settlement of the one of the borrowing is also part of that strategy to move out from some of the high-cost the borrowings and manage our book moving more towards a rupee-based book. That would later on improve the margins. As a quality, quite a good story here. Very well diversified portfolio into various industry sectors. Quite a well spread book. We don't have any concentration risk. And in terms of the NPL, again, it's a nice to see the improvement from a high of 2.87. It has come down to 1.96. So over the last couple of years, we were about 2%, about 2.4 kind of figure. But now we have managed to bring that down to 1.96. And impairment provision that covers the gross loans, that percentage also has improved. It's 1.37. The deposits, that's where we had quite a substantial growth. As you can see, from 2016, the first quarter, we had 12% growth. By first half, we had 17% growth. And by third quarter, 25% growth in deposits. And all in all, the quantum-wise, 52 billion growth in deposits. We were concentrating hard on this. We got our branch network to work on this. And we also came up with some innovative, attractive product proposition, mainly targeting our current and saving base. And a couple of products that were launched were the NDB Investment Planner, which is quite a successful product, which has seen quite a good progress. Then the ladies' savings account, earlier women's savings account. Again, quite a good substantial growth, and the entire branch network is actively involved in marketing these products. Then we also introduced a business class relationship banking solution for our middle market and SME clientele, targeting the growth in the current and savings base. We also introduced NDB Achara savings and the loan scheme for the retired pensioners, which was launched very recently. And then we also relaunched our children saving product with an array of quite attractive gifts, good rates, the NDB children savings account. So all these have contributed to substantial growth in deposits, and we'll continue to maintain this momentum and improve our liabilities, so that, and in fact, the branches, the focus also would be growing our liability base to support a low-cost funding. In terms of capital adequacy, we are well within the requirements. The total capital ratio at bank level is 12.5%, and Tier 1 level is 8.7. The minimum is 7.25, so we are well above that. And also the minimum for the Tier 2 total capital ratio is 11.25, and we are at 12.5%. And these are the investor other ratios. The price, of course, in terms of the growth, we had substantial growth, but in terms of the share price, we are not seeing that happening in terms of the share price. And this is something I'm sure when you look at the earnings per share and also the price to book value, this is the share price to book value is 80%, 0.8%. So that's something that the investors should make note of, because so much of potential which is not reflected in terms of the market price. ROE ratio, ROE has improved from 13.3 to 15.6%. ROA again from 0.99 to 1.16. And book value per share has also gone up from 149 rupees to 160 rupees. This is the bank level book value, but whoever who has the investment also have the exposure to the group level. So the group level book value of the share is 186 rupees. So actually the price to book value ratio should be calculated based on the group value of the share. So it would be even around 67%. So that is something the investor should make note of. So basically that concludes the presentation that we have prepared, but I'm sure there will be questions that you may have. So it's now the question line is open, so you can post your questions and we will try and answer to all those questions.
Hello, hi. Hi, can you hear me?
Condominium. I got a question on, can you give some brief insight on the level of loan exposure to condominium projects? Bonita, you want to take it?
If I may answer that question, we don't have an excessive exposure to that. We have entered into this exposure in the recent past. Roughly, we have about 7 billion, 7 to 7.5 billion. But that is on selected SMEs and middle market. But there are also about 80% of it is on the corporate banking. And those are on selected projects where we are quite comfortable, depending on the location. And we are not excessively exposed to it.
Okay. There's another question. Capital is becoming an issue with the Tier 1 CAR ratio coming into 8.7 and the ROE hovering around 10% mark. Actually, its ROE is now 15.2. Gross NPAs are down. So growing the loan book will be a challenge without capital. which will in turn place pressure on the ROE. What's your game plan for this? So that's a question. I think ROE-wise, we are improving, keep on ROE improving, so that 15.2, we will continue to focus on that. So that will be more attractive for the investors who put in capital. But in terms of our projections for the next year, I think we are quite well within the requirements in terms of meeting our loan growth, so that excessive capital currently available is sufficient with the retained earnings that are coming from the profit that you are earning. We should be able to manage. There's no immediate requirement for capital infusion, but also mindful of the future. We would take a decision whether we need to go for the capital enhancement or not somewhere early next year. But as per the projections, we are quite comfortable of the current capital level. With the risk-weighted assets improving and also the focusing more on the SME and the middle market sector, there are capital advantages that we can use. So we are comfortable that existing capital level is sufficient to manage the next year's growth. There's another question. What is the forecasted impact from IFRS 9 implementation? You want to answer this?
I think as an industry as a whole, we are still confined, and we have engaged external auditors as consultants. So the data is being analyzed, and the impact will be completed by end of the year. It's being deliberated. We need to look at the models and identify the impact. So as an industry, still the impact is being identified, and if you compare the models, we have to align the models in the industry with regulators. So it's still being evaluated.
I think they are here. The banking industry as a whole is working on this. The impact is basically based on the tenor of the facilities, the assumptions that we also make for the construction of those models. Now, one assumption is that there's a rebuttable assumption of how we classify an account, whether it's a near NPL or not. And at the moment, the industry is debating whether it's a 30 plus overdue from 30 plus days, or there are much more closer assessments where we can use either 60 plus rather than a 30 plus. So these are the industry should also work on these numbers, and that discussion is happening. The audit firms are working closely with all the banks in developing these models, and Central Bank is also now fully involved in this process. So still the impact is not properly assessed, but we will continue to work on those numbers. So we have a couple of months more before this is implemented. Sorry. Cash flow hedge. That's a question. Can you please explain the cash flow hedge cost of 829 million for third quarter?
Currently, the bank has a foreign currency swap arrangement with Central Bank for its long-term foreign currency loan. It's a 50% cover. Now, currently, the market, the forward premium rate for long-term tenor is high. So, when it comes to the carry has come down, particularly in this quarter, the forward premiums are high. But this will get corrected over the quarter. And we will expect a positive impact to the equity. And on this foreign currency swap arrangement, we are currently benefiting on the net interest income line over the tenor of this loan, and with the swap arrangement continues.
Okay. That's another question. What is the reason behind the higher tax burden? I think we are on par with the industry, right? 47%?
47, yeah. Currently, the effective tax rate for the industry is about 47%. 28 for income tax. Effective tax rate for financial services is 17%, and NDB of 2%. So altogether, the industry is about 47, and yards are with the industry.
Can you take this one? Help for trading, Niran. There's a question on the help for trading. Why the help for trading in banks value 5.3 billion September, 832 million in December?
Is money from their trading portfolios and also from the FX portfolios. Because we saw opening interest rates in the first part of the year, the rates were quite high, and they started to come down during the latter part of the year. A lot of banks started to hold more in the rather than going into the held to maturity, so that you can realize capital gain.
Okay. There's a question on, can you give your loan growth by each segment? Of course, the loan growth has come from all segments equally, I believe. So we can't specifically say this particular side has grown, but definitely there's a focus on SME retail side. But we have seen the growth coming from all four sectors. The corporate banking.
It's not concentrated to any.
Yeah, it's not concentrated to any of the business entities. It has come from all sides, and also the industries also, it's quite well spread. So corporate banking, the project finance, the SME side, and also the retail products all have contributed to this growth. There's another question. What did you mean by capital advantage coming from SME and retail sector? Yeah, of course, this is the Basel III capital advantage, the risk-weighted assets compared to unrated corporate entity, which is risk-weighted at 100%. Exposure to SME is risk-weighted at 75%. And that's one advantage. And on the housing loans, again, if the loan-to-value ratio is less than 70%, then the risk-weighted assets are at 50%. So like that, there are certain advantages in moving on to the retail and SME space, capital-wise. So that is what I clarified earlier by strategically moving towards that. That will help us to improve on the risk-weighted assets. Other one is to naturally make use of our presence in these locations, branch network expansion, and make use of our presence to contribute to the economy, making use of our strong credit skills. Now, as a development bank, we have built up that strong credit assessment skills, and that is one of the major advantages that NDB is having. And what we are doing is making use of that credit skills, taking to the regions and ensuring that we capitalize on our credit skills. Apart from that, we have a very good refinancing portfolio, and we continue to be the leader in getting the funds and also deploying them, refinancing. So solar or wherever the country's economies, growth rates, the focus is NDB is there to support that. So we use our financing portfolio and also expertise to mix with along with other facilities, so we can actually approach clients with a total package. So if it is a corporate who arrangement. So all in all, for a customer, it's a one-stop shop where we can offer various products. So that's the beauty of NDB having various products to offer to suit the requirements of the corporate. So that's actually we are trying to capitalize on that ability as well. There's a question on are we going for scrip dividends? That is something the board to decide. when it comes to the final dividend payment. But of course, you all are aware that yesterday we declared a 2 rupee dividend payment, which should basically, it's an interim dividend payment. So apart from that, naturally, before we close the year, the dividend, how we distribute the dividend also the board will take into account, keeping in mind the capital required to be retained for the growth, but also looking at the investors and ensuring that since we had a good year compared to what it was last year, naturally we want to share part of that success with the shareholders. There's a question, how happy are you with the subsidiary performance? Bank ROE 15 plus gets diluted down to 10% level at a group level. Would you look at divesting some of these, or what are your growth expectations for the subsidiaries? Now, naturally, the investment banking activities, when in good times, the returns are much, much higher, and we have seen this in the past. So it's basically we are going through a year where very little progress have been made in the capital market side. So, but as the best investment bank in the industry, we have the capacity that are built up. We have the reputation, we have the ability to reach the market. So we are waiting for the opportunities to come. And naturally, the opportunities, the time that we have to wait is not a long time. We know very well that projections, the activities that are happening. The financial center is coming up. Then the government is also looking at divesting some of the SOEs. Now, these are the opportunities that we can also capitalize and get involved, making use of our expertise. So we are quite happy to wait. Return-wise, yes, there may be the slightly drop of return, but we are seeing in the past these entities are giving good returns whenever that opportunity comes, and that has been the practice, and we are happy to take that call when the opportunity comes. Apart from that, I think the activities in terms of the NDB Zephyr investments, that's actually giving good returns. Also the wealth management side, there was a drop because of various tax adjustments and the uncertainty of the tax treatment on the wealth management products, especially unit trust and all. Now that some certainty has been given, so we have seen funds coming back for the wealth management activities, and this is moving towards more retail-based wealth management products. Now the strategy of having NDB branch within the wealth center is also basically catering some of these wealth management products to the retail sector. So we have planned, we work as a group to capitalize on cross-selling opportunities and ensuring that group synergies are basically get out from the bank. So if you see our tagline, unlocking our potential to unleash yours. So this is what we have been doing, unlocking our potential within NDB. NDB has so much of potential. We one by one unlock and use when we started the year, and we see the progress as an on when we unlock each potential which we have within the bank and the group. Okay, there's a question. Can you share some insight regarding future plans on digital banking? Okay, this is a major area that we want to focus on. Apart from the branch expansion in terms of brick and mortar branches, the reach is important, and we are investing on the digital platforms. We recruited some key staff also, and developing as one of the strategic pillars. So we can hope app is the best in the market. Similarly, we have the branchless banking. There is a strategy in terms of moving toward the cash deposit machines, a cash recycling machine, using the digital channels to provide that convenience to our clients and ensure that we get a bigger share of customer business. So we are quite focused on developing, growing that area. Loan growth solely. Loan growth deposit loan. Okay. Another question, out of 1.2 billion other operating income, how much of it is a dividend income? I think we are 1 billion. So we received 1 billion. So out of that, 1 billion came as a dividend income. So even if you exclude the dividend income from the group, still it's a 50% growth in profit after tax. Yes. 50 between corporate project finance and the retail and SME. In fact, the details are given in the presentation. Corporate roughly about 35%, project finance we are 22%, then the rest is retail and SME. But this mix would naturally go more towards the retail and SME because that's an area where we are focusing on. Okay, there's another question. Thanks for all the answers so far. Last one, what was the impact of the prepayment of foreign currency loan in LKR terms at OPEX and PAT level? I think the prepayment penalty was, of course, you would have seen in the increase in the operating expenses. The prepayment, the charge was roughly about, what's the percentage? Yeah, so it's about the prepayment charge is about 1% of the loan exposure, and we are quite comfortable with the reduction in the interest saving because we were paying a higher rate compared to our ability to lend it. So there was actually there's a negative gap. So even taking a 1% prepayment penalty, we are comfortable that we can actually wipe it off during the year, and this is happening, which we see the improvement in the margins. So by end of the year, we will be basically covering the entire prepayment penalty cost. And the beauty is that the benefit going forward for the next 3.5 years is substantial. So that is something that you would see later on. But we'll be covering this prepayment penalty during this year itself. Actually, the interest savings on the dollar loan was around 3%. So that saving alone is sufficient to cover a 1% prepayment charge. Okay. Any further questions? there's a question, was the prepayment penalty carried on the group and not on the bank level? Actually, it's on the bank level. Why has the individual impairment declined? Was there a specific loan that has already been provided for?
If you look at based on the questions that you asked during the previous quarters, we took a heavy figure on the impairment based on the objective evidence that we had, and with that, I think the portfolio has been cleared, and the impact on that is that we have a much better portfolio and with less impairment getting captured.
I think we have not received any further questions. But if you have any questions, feel free to reach us through our email address investor.relations@ndbbank.com, or you can call us. The numbers are given in the presentation. So thank you very much for participating in this webinar, and we are quite pleased with the progress so far. We have substantial plans. We have devised a strategic plan which takes us up to 2020. More and also growth coming from all sectors, but more focused approach in the retail and SME space. And in that growth, we are looking at getting the balance sheet up to a sizable level so we can become a systemically important bank by 2019. And that is one of the strategic goals that we have. And it's not really but definitely when you reach, definitely we look at other options, overseas options as well. So far we have seen quite a good progress, which is reflected in the financials. In terms of staff support, we work as one NDB, as a program that is basically getting the staff to work as one NDB and contribute, and that actually shows tremendous results. And within the bank, also within the staff, we are quite motivated to achieve these numbers, and we are comfortable that we can deliver those numbers and continue to progress. So thank you again for the participation, and thank you for my colleagues also for taking part. So please feel free, if you have any clarifications, to write to us. Thank you. With that, we conclude this webinar.